Welcome back. Today, we're diving into Benjamin Graham's timeless classic, The Intelligent Investor. First published in 1949, this book is often called the Bible of investing. Warren Buffett himself said it was the best book on investing ever written. In the next 5 minutes, we'll break down Graham's most important ideas and examples. Part 1. The difference between investing and speculating. Graham begins by drawing a sharp line between investors and speculators. An investment operation, he states, is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Investors focus on the long-term performance of the underlying business, aiming for safety and steady returns. Think of steadily contributing to a broad market index fund, a strategy built on the economy's long-term growth. Speculators, however, chase quick profits by betting on price movements, often driven by market hype. This is like jumping on a volatile meme stock based on social media buzz, hoping to sell to someone else at a higher price before the trend collapses. Graham warns that while speculation isn't inherently bad, it must be strictly firewalled from your core investments. He advises setting a clear policy. Allocate only a small portion of your capital, perhaps 10% or less, to a separate account for these high-risk plays. This prevents speculative losses from jeopardizing your financial foundation. Graham points to the 1920s stock market boom, where many people speculated wildly and lost everything in the 1929 crash. He contrasts this with prudent investors who held diversified, fundamentally sound securities. They weathered the storm far more safely because their decisions were based on value, not vapor. Part 2. Mr. Market. Analogy. One of Graham's most famous lessons is the parable of Mr. Market. Imagine you own a business, and every day your partner, Mr. Market, offers to buy your share or sell you his. He is the personification of the stock market itself, driven not by logic, but by emotion. Some days he's euphoric, seeing only good news, and quotes ridiculously high prices. On other days, he's inconsolably depressed, fixated on problems, and offers you bargain prices that seem too good to be true. The intelligent investor doesn't let Mr. Market's mood dictate their actions. Instead, you establish a practical routine. First, you determine the business's intrinsic value, independent of the market's noise. Then, you set your own buy and sell ranges around that value. Your job is to check his prices, not his moods. For example, if Mr. Market offers a euphoric price far above your sell range, you simply ignore him. A week later, when he's panicked and offers a price well within your predetermined buy range, you calmly make a purchase. You take advantage of his irrationality. Buy when he's pessimistic, sell when he's overly optimistic. Graham highlights how during the Great Depression, Mr. Market priced solid companies far below their intrinsic worth. Patient investors who bought then, like those who purchased Northern Pipeline shares at bargain levels, profited immensely when prices inevitably recovered to reflect their true value. Part 3. Margin of safety. Perhaps Graham's most important and certainly most famous principle is the margin of safety. It's the central concept of value investing. This means buying securities at a price significantly below their calculated intrinsic value. This gap isn't just for potential profit, it's a crucial buffer. It ensures that even if your analysis is slightly off or if unforeseen problems arise, your capital is protected from permanent loss. For example, if you determine a company is worth $100 per share, Graham advises buying only if the price drops to $70 or even 65s. Now, imagine the company's earnings unexpectedly fall by 15%, pushing its true value down to $85. Because you bought at $65, your investment is still sound, protected by that initial cushion. This buffer, the margin of safety, is what truly reduces risk and creates the opportunity for substantial profit. In his book, Graham discusses railroad bonds that were trading at steep discounts to their face value. He knew that even if the railroad's earnings faltered, the extremely low purchase price provided a powerful layer of protection against loss. He applied the same logic to stocks, noting how buying at 2/3 of their appraised net asset value created a cushion against errors or market downturns. This isn't about one lucky purchase. It's about building a diversified portfolio where every holding has its own margin of safety, creating a fortress of value. Part 4. Defensive versus enterprising investors. Graham divides investors into two types. Defensive investors want simplicity and safety. They should stick to diversified portfolios of bonds and high-quality stocks. Enterprising investors are willing to put in more effort, analyzing undervalued companies and special situations. For instance, Graham highlighted how careful analysis of neglected stocks, sometimes called cigar butt investing, could yield solid returns if bought cheaply enough. Graham cites GEICO, Government Employees Insurance Company, which he himself invested in. At the time, it was overlooked and undervalued, but careful analysis revealed strong fundamentals. Enterprising investors who bought GEICO early reaped extraordinary returns. Final takeaway. The essence of the intelligent investor is discipline, patience, and rationality. Graham's advice is clear. Don't try to outguess the market. Instead, focus on value. Protect yourself with a margin of safety, and remember that Mr. Market is there to serve you, not guide you. That's the heart of Benjamin Graham's The Intelligent Investor. If you apply these principles, you'll not only protect your money, you'll grow it wisely over time.